In this lecture, we're going to look at other short-term decision-making situations that management might find themselves in. These include discontinued business segment, make or buy, and sell now or process further. The first situation is the discontinued business segment. First of all, what is a business segment? And really that means any method or any segment or piece of your business that you want to divide your business up. Managers can divide their business up in multiple ways by product type, by geographic location, by business function. Those are all options that are commonly used as business segments. So a business segment, in short, is just any way you want to divide your business up, and there's usually a business can be divided up in multiple ways. Then we have to decide, should we discontinue an unprofitable business segment? And obviously, if something is unprofitable, you want to discontinue it. But we need to consider this from an incremental analysis because we could unexpectedly hurt our business. Let's look at this example. We have a business and they've brought to us this information, this report, and it shows us that our company that makes 3 different products, mowers, chainsaws, and trimmers, has one of the business segments based on product type that seems to have a negative operating income, that negative profitability of $38,000. Managers in other departments figure the best thing to do is to get rid of the trimmer division, and if we get rid of the trimmer division, that would logically make our operating income go up by $38,000. However, what we'll see is that getting rid of the trimmer division will actually hurt us. If you look at this financial statement, you notice that it doesn't give us cost behavior. We understand that variable costs and fixed costs behave differently. Our fixed costs are going to be there whether we sell the trimmer or not. And so we need to get another report, one that shows us cost behavior. So here's another income statement, and what we're doing is we're just seeing that instead of looking at cost of goods sold and selling and operating expenses, we're looking at cost behavior. So any cost that's a variable cost is put together and put on the line for variable cost, and any cost that's a fixed cost is put in the fixed cost area. So when we look at this, let's consider what would happen if we eliminated the trimmers based on cost behavior. So if we eliminate the trimmers, we're obviously going to eliminate the sales from the trimmers, and we're going to eliminate the variable costs. But then a question comes up, what about the fixed cost? We understand that if we have fixed costs, they may not all be eliminated. So we have to get further details into our fixed costs and understand which cost will go away if we get rid of the trimmers and which costs will stay. So the avoidable costs are costs that will go away if the trimmers are discontinued. What is included in avoidable costs? Well, always the variable costs are avoidable, but we've already seen that. We've taken the variable cost out. And then sometimes the fixed cost will be avoidable depending on the situation. So if we look at a list of our fixed costs, we see that the building lease, equipment lease, advertising make up our fixed cost. Well, the building lease is unavoidable. So that's going to be there. The equipment lease, we can avoid $32,000 in equipment that's only used to make the trimmer. So if we quit making the trimmers, we would avoid the $32,000 in equipment lease for the trimmer equipment. The advertising, we could avoid $45,000, and the reason is because there's some advertising that just advertises for the trimmers, and we would quit doing that. So our total avoidable cost would be $77,000. So of the $162,000 fixed cost, $77,000 would be avoidable. That means that we would have $85,500 that would be unavoidable. So the $85,500 that's unavoidable now needs to be split up and put in the other departments, needs to be put in the mowers and chainsaw divisions because we will no longer have the trimmer division to absorb those costs. So looking at this now, since we've taken the fixed costs that were in the trimmers and moved it over into the mowers and the chainsaws, those unavoidable fixed costs now add to additional costs in those divisions. And what we see is that our total operating income has actually been harmed or reduced. If we look at the initial situation, when we looked at the first financial statement, we saw that our operating income was $2,024,500. Now we look at it with the trimmer being eliminated, and we see that it's gone down to $1,977,000. The reason is because we lost out on the contribution margin that we were making earlier when we were selling the trimmers, and we didn't get rid of all of the costs that were fixed costs. We only got rid of some of the fixed costs. Understanding cost behavior helps you to make decisions like whether or not you should discontinue a business segment. Let's look at this from an incremental analysis where we have two options. So this is the same situation. It's just that instead of looking at it from each of our products, we're just looking at it from the two options: continue the trimmers or eliminate the trimmers. And we see that by continuing the trimmers, we'll get the sales, we'll get the variable cost, of course, and we'll have all of the fixed cost. If we eliminate the trimmers, we'll end up getting rid of the sales and variable costs, but we'll only get rid of $77,000 of the fixed costs, leaving us $85,500. What that means is that our operating income is going to be harmed by $47,800. Even though the continuing brings us a negative $38,000, if we eliminate, it's going to bring us down by $85,800. What that means is that our difference is that we do better by continuing with the trimmers of $47,800. Understanding cost behavior can help us from making a poor decision whether or not to eliminate a business segment. Our next short-term business decision is a situation of whether or not to make or buy a product or component product. Our company is iLink, and we make earbuds, and we currently manufacture 2 million units. The total cost to make the earbuds, $4 for material, that's a variable cost. Direct labor is 50 cents, that's another variable cost. And the variable manufacturing overhead is $1.50, and this is for each earbud. So those are all three our variable costs. Then we have some fixed cost at $4 million. Now, if we look at that on a per unit amount, that's $2 per earbud. We have an offer from an outside manufacturer saying they will make the earbuds for us for $7 each. When we consider this, the knee-jerk or initial reaction is to add up all of our costs. Adding up all the costs brings us to $8. The earbuds they're offering to make for us at $7, so we say, oh, okay, well, it's cheaper to buy the earbuds from an outsider. However, remember that we need to consider the cost behavior. Fixed cost and variable costs aren't going to behave the same in this situation. We need to look at incremental analysis as a way to make this determination. So with incremental analysis, we want to look at two alternatives. One is make and one is buy. So if we make the earbuds, it costs us $6 in variable costs. $4 plus $1.50 plus the 50 cents. That's $6. If we accept the offer, that would be $7. So the $7 per unit brings us to $14 million. Buying the product from the outside third-party manufacturer would cost us $14 million. Variable costs are $12 million. What about the fixed cost? Again, we have to determine which costs are going to remain and which costs are going to go away. The fixed cost for the current situation of making the earbuds in-house is $4 million. If we buy them from a third party, we're going to get rid of some of the equipment, and what that's going to do is result in our fixed cost being reduced, but not in total, only by $500,000. So now we look at our total cost. An opportunity cost is when we give up a benefit when one choice is made over another. Another concept that's important in these decisions is called sunk cost. Sunk costs are costs that incurred in the past. So even though we purchased the machinery to make the earbuds, we don't want to consider those costs that we already spent in the past to buy that machinery. We only want to look at what are the implications of our decision in the future. So past costs are what they call sunk costs. In our situation, the management determines that they can take the extra space now being used to manufacture earbuds in the factory, and they could lease out that space to another manufacturer who's looking for space. In other words, they could sublet some of their factory to a third party, and that would bring in $2,500,000. That's what we call an opportunity cost. If we continue to make the product, we won't get any of that $2,500,000. But if we decide to go and buy from an outside manufacturer, then that's going to free up the space and provide the opportunity. And that $2,500,000 is going to reduce our cost in our factory by $2,500,000. When we factor in the opportunity cost, we see it reduces net cost. So it's more costly to continue to make the product. Understanding opportunity cost is important for managers because it can have an impact on the decision making. Our final decision making concept that we're going to look at today is the sell as is or process further decision. So a lot of times products go through a process and you can sell them at any point. You could take a dairy farm where they have milk and they could turn that into cheese or yogurt. They could continue to process it and sell it at any point. Petroleum oil could be turned into diesel, which could be then turned to gas, to jet fuel. Another example is unfinished furniture, which could be sold as is or painted and sold at a higher price. And then finally we have whole peanuts, an agricultural product, and we could take that and sell them as is, or we could sell them shelled or crushed or continue to further process them as peanut oil. The point is that we need to determine whether or not the additional cost to further process is going to be more than the additional revenue that we could make from the more refined product. In our example, we have peanuts, and our factory can either shell them and sell them as is, or they could sell them crushed to be used in recipes. So the estimated sales if we sell them shelled is 50,000 units. If we crush them, we expect to sell 40,000 units. The price will be $5 if we sell them shelled, $7 if we sell them crushed. It will cost us an additional 75 cents per bag to crush the peanuts. So in our incremental analysis, we have two options: sell now, sell them as shelled peanuts, or process further and sell them as crushed peanuts. The revenue that we would make if we sell them now is $250,000. The revenue that we would make if we sell them as crushed peanuts would be 40,000 bags at $7 each, or $280,000. We do have an added cost if we want to crush them, and that's 75 cents per unit. At 40,000 units, that's $37,500. So we just want to look at the impact to operating income. If we sell them now, we would bring in $250,000. If we process them further, $242,500. It seems that the cost to crush the peanuts is more than the additional revenue that we would make. And these sell as is or process further situations, the key to this is to determine whether or not the additional costs for processing are going to be more than the revenue that we're going to bring in from additional processing.